Hey, how you doing? Emmett Dempsey, Treasure Coast Mortgage. Here is the rate update for April 12th, 2024. And it's been a heck of a week, ladies and gentlemen. Basically, rates are up all over the board, and the highest rates that we've had in a very long time, really since October, I believe, is the last one. They went up the fastest in a long time. So let's take a look at it and see what happened and why. So first, the why, same story. Inflation and employment. Until inflation comes down and the labor market starts to crack where we have more unemployed and the economy heating, the hotness of the economy comes out, the Fed will have no reason to start cutting rates. I know starting out this year, we had anticipated 6 rate cuts. And this is after Christmas, going into the new year, everybody had high hopes, but inflation is just very persistent. It's really not going anywhere. I'm sure you can kind of feel that going to the grocery store, filling up your car. Now, who knows if before the election they're going to mysteriously drop, but right now inflation rates are very high. So let's go ahead and take a look at where rates are and where they're today. So basically, you can go on my website, tcmortgage.com/rates. You can see your 30-year conformings are solidly in the 7%. So your FHAs in the high 6s, the VAs as well. Basically rate ranges, anywhere in between there. Of course, this is all very general. Rate ranges, national averages, this kind of gives you a barometer or a general idea of where things are. But let's take a look and see. Now, today on Friday, on April 12th, we've recovered, but let's see what happened, okay? So you can see this large red drop right here. It's really... we had some lock alerts just before that. So basically, if I have loans in the pipeline, I'll be able to lock those loans before we anticipate any potential rate drops. But you can see here today we hit this 50% Fibonacci level, which is not technically a Fibonacci, but basically it's a good sign of a potential bounce back. And if this closes here today, then we can kind of see a move up. That way. But just generally where we came from in the last 6 months. You remember, down here, whereas in October we were at over 8%. We saw some price improvement. So we're still better than when we were in October. So rates are in the low 7s. Maybe in the high 6s. Depending if you get buy downs. Remember, 2-1 buy downs are very, very prevalent. You get seller credits to pay the first 2 years. So how that works is. The first year is 2% lower, then 1% lower, and back up to note rate. There's even 3-2-1 buy downs. So we just have to figure out some strategies. So you don't have to pay market rates if you have good realtors who make offers as part of your offer in order to offer concessions to help buy down your rate for a couple of years. So we're just waiting for this to power through this inflation. Basically, it's a COVID hangover from overspending. So until that happens, really nothing's going to change, So that's kind of what we have. And very simply, you just have to kind of write it out, talk to your loan officer, figure out what your rates are, make sure you shop around. Definitely, as a broker, we have multiple options, so we definitely take a look at, depending on your situation. And the whole adage about waiting to buy until rates come down, that's a very not good idea. So history has shown, and I can pull up one of my presentations. Basically, if you did that, I think it was like in the 70s, you'd be waiting until the early 90s before rates came down, because the fact remains, and I'm going to put this in my newsletter, that I think it's over 82% of sellers have a rate below 4%. So there's no inventory. And I've talked several times about how after 2008, all the builders went in the wilderness and nothing really happened. And then 15, 17 years they were gone. And then all of a sudden now they're playing catch up. And there's just not enough housing inventory. And then not only that, the existing housing inventory, sellers are sitting on a ton of equity, and they also have really low interest rates. So the buyer lock-in effect is still very much in effect. Sellers are not moving anywhere. So rates are still persistent. And this is where rates were when I first started in 2007. So, the rates in 2s and 3s, ladies and gentlemen, that's not normal. And it may never return. And the only thing for it to 2s and 3s to return are something very bad to happen, like a COVID 2.0, something of that nature. So I wouldn't wish for that on our economy or the world economy again. So you just have to kind of figure out higher interest rates. Maybe start with a smaller house. Figure out buy down options, 3-2-1 buy downs, 2-1 buy downs, permanent buy downs. So we look at those different options that are ways to mitigate your interest rate costs the first couple of years to help you get into that new home and at least make the first couple of years palatable. And so there's that. So that's kind of it in a nutshell, guys. Basically, what we anticipate coming up here is we kind of had a bounce back. So we've making through some support levels. There's a lot of upside potential for next week. Just keep an eye on inflation reports and as well as jobless claims, because until those things crack, the Fed has no reason to lower rates. So I think we're going to be higher for longer, and that's kind of where we're at. And of course, if you're under contract and your loan hasn't been locked and you have no idea what's going on, send your loan estimate to me. You can go. All my information is in the show notes. Definitely send me your loan estimate. Let me know how we can match or beat it, and to figure out how we can save some money on your interest rate. So take a look there. On the home front, football starts again tomorrow. I'm an I-9 flag football coach. Definitely a great organization, and look forward to that. And if I don't talk to you, have a great weekend, and I'll see you next week. And pray for better rates next week.